What if lowering your payment today costs you hundreds of thousands of dollars later? The Trump administration and the FHFA they just floated in the idea of 50-year mortgages. Wow. The pitch is pretty simple. You lower your monthly payment and make homeownership more affordable for everybody. But here's the problem. Nobody's talking about what it actually costs you over time. I'm going to run the real numbers, show you the trade-off, and I'm going to help you understand if this proposal helps you or hurts you. Here's what they're saying. Right now, most buyers are stuck with 30-year mortgages. And between high payments and high rates, a lot of people just can't qualify. So the proposal is to stretch the loan to 50 years instead. It lowers your monthly payment. It could save you some money every month. And on the surface, that sounds like it's got some relief to it, especially if you're a first-time home buyer trying to get your foot in the door. The idea came from Bill Pulte at FHFA under Trump's administration, but framing it as an affordability solution. More people qualify, more people buy homes, right? So the housing market stays moving and the party stays on moving. On the surface, it makes a lot of sense. If this proposal goes through, you get a conventional loan through Fannie Mae or Freddie Mac with a 50-year term instead of a 30. Your principal and interest payment would be lower because you're spreading the same loan amount over 20 extra years. The loan structure stays the same. You still pay closing costs, but here's the catch. Just like 15-year mortgages have lower rates than 30-year mortgages, a 50-year mortgage would have a higher rate, guys. And it's probably about 0.5% more. So you're not just stretching the timeline, you're also paying a higher rate. And that's the part most people aren't calculating. So a lot of the comparisons, they use the same rate as a 30. That's not true. How you doing, guys? My name is Emmett Dempsey. I'm a mortgage broker here in Florida. And I've been in this business for over 17 years, helping buyers and homeowners just like you understand the real math behind mortgages and all these new proposals. If you want clear guidance, zero hype, go ahead and hit the like on this video. I really appreciate that. And go ahead and check the resources in my link comment below. Okay, so let's run an example. Say you're buying a $500,000 home, $500,000, and you put down 20%, so you're financing $400,000. Based on November 2025 rates, a 30-year fixed mortgage is going to be at 6.5%, gives you a payment of about $25-28 a month. But on a 50-year mortgage, that rate would be about 7%, not 6.5%. That's how it works with longer terms. The bank charges you more for the extra risk. So at 7% over 50 years, your payment drops around $23.89. You save about $139 a month. That's it. You're buying a $500,000 house, and you're saving less than $5 a day. And you're paying a higher rate to get there. Now, I know what some people are thinking. $140 a month, it's real money. It's not nothing. That's almost $1,700 a year. And over 5 years, that's over $8,000, right? And if you're trying to qualify, that lower payment might just be the difference between approval and denial. I know, I've been there, and I get it. But you have to look at what you're giving up to get that savings. And here's what no one's really talking about. On that $400,000 loan at 6.5% over 30 years, you'll pay about $510,000 in interest. That's already more than the house cost. But on a 50-year loan at 7%, you'll pay over $1 million in interest. $1 million. That's an extra $523,000. You're paying more than double the interest just to lower your payment by $139 a month. So let me put it another way. Okay, you're saving $139 a month, but over the life of the loan, that costs you $523,000. That's a really bad trade. But here's a bigger problem, and this is what most people don't understand until it's too late. Your principal balance, it barely moves. Let me show you what I mean with the actual numbers. In the first 5 years of a 50-year mortgage, you only pay down $5,000 of that $400,000 loan. After 5 years of payments, you've barely touched the principal. On a 30-year mortgage, you pay down about $25,556 in that same time. That's almost 5 times more equity. $5,000 versus $25,000. It's crazy. In the first 10 years of a 50-year mortgage, you'll pay down about $12,000. After a decade of payments, you've barely made a dent. You still owe over $387,000 on a $400,000 loan. On a 30-year mortgage, you pay down about $60,000 in that same time. Again, almost 5 times more equity. And by year 15, that gap gets even worse. On a 50-year loan, you pay down about $23,000. You still owe over $376,000. And on a 30-year loan, you pay down about $110,000. You're almost halfway done with your 30-year mortgage at that point. And you only owe about $290,000. But on a 50-year mortgage, you've barely started. And this really matters, guys. If you ever want to sell and move up, let's say you're a first-time home buyer, to start a home, And maybe you've got one kid and you're thinking about having another. Or maybe you got a job offer in another city. Or maybe you just want a bigger house with a bigger yard and a pool and all the things, right? Or you want to build equity so you can eventually sell and upgrade. But if you're on a 50-year mortgage, you're pretty much stuck. And here's why. When you sell a house, you have to pay off the existing loan. So whatever's left over after you pay off the mortgage is profit. That's what you take to the next house, and the next house, and the next house. But if you only pay down $12,000 after 10 years, and your house has maybe appreciated 5 or 10%, you might not have enough equity to cover the closing costs and the down payment on your next place. You're effectively trapped in that home and starter home for decades. The 50-year mortgage doesn't just cost you more money. It kills your mobility. It locks you into a house that might not fit your life 5 or 10 years from now. And that's a huge cost that no one's talking about. Now, there are a couple scenarios where a 50-year mortgage could make sense. If you're a first-time home buyer who absolutely can't qualify any other way, and you plan to refinance in a few years when rates drop, this might get you in the door. The idea will be to use a 50-year mortgage as a bridge. You get in the house now, then refinance to a 30-year or even a 15-year when rates are better. That is a strategy, okay? But it only works if rates actually drop. If they don't, you're stuck. Or if you're a real estate investor, you only care about monthly cash flow and you're going to sell the property in 5 years anyway, the long-term interest costs might not really matter to you. You're not planning to hold the loan for 50 years. Or maybe you're planning to flip it or sell it for appreciation. In that case, the lower payment helps your cash flow right now to carry that property until the end. And you're out before the interest really piles up. Or maybe you're older and you're buying what you know will be your last home. You're not planning to move anytime soon. And you're not worried about building equity because you're not selling. You just want the lowest payment possible so you can enjoy retirement. In that case, a 50-year mortgage might work. Although at that point, you'd probably be better off looking at other options. But for most people, this isn't a win. It's a trade. You get short-term affordability, but you lose long-term wealth. And if rates don't drop, or if you can't refinance, or if life changes and you need to move, you're stuck, paying for that extra interest for decades. So here's my main concern. This proposal targets the exact buyers who can least afford to pay extra interest. It's first-time home buyers. People with very tight budgets. Their family's just trying to get into home ownership. And you may be one of those people. Those are the people who need to build equity now. Now, pay the bank an extra $500,000. It's really crazy. And here's what also bothers me. Most first-time home buyers don't plan to stay in their starter home forever. Okay? They want to build equity. They want to sell in 5 to 10 years and move on to something bigger. And that's how home ownership is supposed to work, guys. You start small, you build equity, you move up. But a 50-year mortgage breaks that path. And you can't move up. If you don't have any equity, you're kind of stuck. If you're already stretching to buy, adding 20 years of interest payments and killing your equity growth doesn't solve the problem. It just delays it. And in some ways, it makes it worse. Because now, you're locked into a payment for half a century. So here's the bottom line. A 50-year mortgage lowers your payment, but it costs you way more in interest. For most buyers, that trade doesn't make sense. And if you're thinking about this proposal, run the numbers first. I can help you with that. You need to look at the total costs, not just the monthly savings. Okay, look at how much equity you have in 5 years, 10 years, 15 years. And I can help you run with that with a mortgage coach. Just give me a call. And you need to think about whether this house will still work for you in a decade. Think about whether you'll be able to refinance if rates drop. And I can help you run those scenarios. If you're a homeowner watching this, you might be wondering if now is a good time to refinance or should you wait for rates to drop even more? You never know. So here's the thing. Waiting for the perfect rate could actually cost you more than refinancing today. And I break down the real math and I show you how to decide in this video right here.